The U.S. Census Bureau just came out with statistics just this past week on the fact that they anticipate 33% of homeowners and renters facing eviction and foreclosure within the next 33 or 2 months. And so, what that really looks like, because the courts are so backed up and all of that, we won't really go into, because there's so much to figure out as far as what kind of Congress figures out for the American people and stuff. But let's talk about the 203K specific. Like, let's anticipate that there is a certain percentage of these homeowners that are going to lose it. We won't necessarily, you can dabble in how much you want as far as where the economy goes, but mostly like, where is the opportunity for 203K borrowers coming up in 2021?
The big upside with 203K loans is they allow you to buy beat up properties, as is properties, foreclosure properties that you couldn't just buy. These millennial retail buyers, they couldn't buy any of these houses anyway. So you're basically eliminating all of the competition right there. Very few people, obviously people on this podcast, people that listen to this podcast, people that want to make a good financial decision, yes, that's your competition. But anyone listening right now, you're in the 1% of the 1%, right? Your average, Sally and Johnny, they just want to move in ready home, and they'll pay whatever they have to get it, right? It's an emotional buy for them. The 203K, you're able to build value into your property, right? You're able to get a deal, so to speak, right? You're able to build equity in your deal so that, the first property or the next property that you buy, instead of, paying absolutely top dollar and being underwater on your mortgage for the next 30 years or for a couple of years if the market tanks, you're going in with equity, and you can use that equity to buy more houses, expand your portfolio, invest in a business, whatever that is, right? So what I'm getting at here is the 203K really just allows you to only compete with other people that are buying renovation loans. Here's the reality. People always ask me the question. They're like, how do you compete with cash buyers? The answer is, you're not supposed to be competing with cash buyers, because the reality is I'm a cash buyer, right? In my flipping business, I can't pick up properties and make a deal as easily as someone using a 203K, because the 203K loan, as you guys may already know, is an FHA loan. You only need 3.5% down. You're using owner occupancy, right? You're going to house hack with it. So you're getting that super low interest rate. These interest rates are super low now. They're probably going to stay low for a little while, right? So, whereas a cash buyer, people tend to think that cash buyers are just guys that sit on mountains and mountains of cash, right? No, the reality is they're using other people's money. They're using other investors' money. They're using hard money. They're using private lenders. But all these people, they want to see returns on their money. The average return for a private lender or hard money lender is 10%, right? So you're putting a 10% interest rate versus a 3% over 30 years. My deals are much harder to find than yours. And so this is what I'm getting at. When the foreclosures hit the market at a discounted rate. The foreclosures are definitely going to be discounted. The banks know that they can't sell it at top dollar, because they understand that it's probably beat up and you're buying it as is. So you're really only fighting against very unsavvy fix and flippers or other people within the 203K market. Foreclosures really aren't good deals for guys that do cash and fix and flips, right? You're able to pay way more than a fix and flipper is, ideally. Now, in this last year, you saw people overpaying for things left and right. But in a healthy market, in a healthy economy, the beauty of the 203K is you're going to be able to pay what the bank's looking for, and you're not going to have to really worry about the competition with these fix and flippers.
Yeah, for sure. And a lot of these like HUD homes and some of the other Fannie Mae properties and such, they will actually have time periods for owner occupied properties. So whether it's single family, whether it's multifamily, they allow 15 to 30 days, depending on the particular protocol for that property, for only owner occupied, which allows these renovation loans to come in and have even less competition up front. Where cash buyers, if they're buying it for an investment property, they can't even make an offer until a certain day in the cycle. And so that's another advantage for sure. And I bought mine from a bank. So it's very doable, very practical. I believe yours was as well.
Yeah. It was exactly also with that program you were just talking about. HomePath calls it the first look period. The truth is that a lot of banks have this. They're called different things, but a lot of banks, they whatever they get on their end, whatever benefit they have on their side, selling to homeowners, to owner occupants. HomePath isn't the only one that does something like that. Again, HomePath calls it the first look period. It's like a 15-day period. I put in my offer. They reasonably have to accept any reasonable offer that comes in during that period. And again, in a healthy market, they're not screening offers, right? You're seeing a lot of very immoral stuff happening right now in the market. You're seeing a lot of offers getting screened, everything like that. And there's a lot of blood in the water right now. So, it's, like you said, with the foreclosures that are going to hit the market, they're out there. They're absolutely going to happen. I mean, there's no way the banks aren't going to get their way. So when that time comes, that little flood, that little glimmer of opportunity, it's going to be important to really have your ducks in a row and be ready to strike when the iron's hot.